Gold hit a new all-time high in late September, and silver hit a new short-term high in early October. But following that, the Fed came out with a blockbuster jobs report for September, which pushed precious metals into a profit-taking slide. In this gold market commentary for October 11th, 2024, I'm going to detail all of the new economic information that's come out in the last couple of weeks that caused precious metals to skid, where they found support, and why they've rebounded just in the last two trading sessions. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We are a national, physical, precious metals and vintage U.S. gold and European coin dealership. If we can help you with any of your physical precious metals needs, whether you're buying or selling or simply want some advice, we'd be happy to have that opportunity to try and help you. So in this gold market commentary, I'm going to drill down on how gold and silver have dipped, held support, and now they've rebounded. We'll show you where gold and silver have found major support. We'll go over the strong September jobs report, but there's been a weekly surge in unemployment claims that's a bit concerning. We got the two inflation reports this week for CPI and PPI. Inflation's still a little sticky. The dollar against a basket of currencies on the dollar index and treasury yields have rebounded from recent lows, which have contributed to precious metals prices skidding lower, but they might be peaking now. We're also going to talk a little bit about how Israel might respond to the recent Iranian ICBM attack. It's been kind of quiet this past week, but we're waiting for the other shoe to drop, and it's not going to be good. And we'll go over, of course, the latest charts for gold and silver and talk about a couple of our specials. So let's get on with our technical analysis. This is a month-to-month jobs report from the BLS for the total non-farms payroll report that comes out monthly. As you can see, since December of 2023 going into June of 24, the trend was lower, but that's now reversed. First of all, we had July and August revised upward of 72,000 cumulative jobs with the release of the latest information last week from the Fed. And of course, we got at the same time that blockbuster 254,000 jobs report for September, which was stronger than everyone had expected. So it appears that Chairman Powell's concerns over the U.S. employment situation may be a bit premature based on the revisions and the blockbuster September job creation report. But we must note that most of the jobs that are being created are coming in two big sectors. One is government, and the other is healthcare as the baby boomers continue to age. So we expect that trend to continue, but the jobs report was remarkably strong, which helped to buoy the dollar and treasury yields and push gold lower. We'll get into that in just a bit. This is something we haven't talked about before. It's the weekly unemployment insurance claims report. The blue dots are the weekly initial claims, which are smoothed out in that 4-week purple line moving average. I've highlighted a couple of sectors here with those red circles to point out how last summer, in the summer of 2023, we had a cluster of higher unemployment claims coming in right around 260,000 per week, and that diminished through the second half of last year, bottoming in early part of this year, with claims coming mostly a little under 200,000 in that second circle. But then the trend since April, May has been higher, and it's choppy, but now we've just gotten a real outlier with the claims jumping from about 220,000 on a weekly basis to 250,000 in this last week. Now, to be fair, this could be a bit volatile over the next couple of weeks and may be volatile right now due to Hurricane Helene hitting Florida and North Carolina, causing some claims that might have been filed 2 weeks ago not to be filed, and that then got filed this past week making the total for the past 2 weeks lower at first and now higher. We'll have to see. And now, of course, we've got Hurricane Milton, which has ravaged Florida. My heart breaks for Florida right now with the situation it's in with Hurricane Milton. But I do expect claims to continue to increase, primarily because of that second storm. It's really going to affect things for a while. So this could be jumpy, but we'll have to see if the trend continues upward. This is what Chairman Powell really wants to defend against: higher unemployment, which is why the Fed gave us that jumbo rate cut, to perhaps the detriment of inflation. Let's take a look. This is the consumer price index going back to 2000. You can see off to the right the big spike, which has now come way down. So headline CPI printed at 2.4% this month. It's 0.1% less than it was in August. So headline CPI inflation continues to cool down towards the Fed's 2% target. Meanwhile, core CPI inflation, excluding food and energy, is up a little bit. It's 3.3% for September. It was 3.2% in August. So CPI on the core levels being a little bit sticky right now. And the same thing has occurred with the producer price index. These figures were just released this morning. So you can see the producer price index for finished goods has been a bit choppy over the last 2 years, but it's come way down from where it was in 2022. We've got the print for the regular producer price index at 1.8%. It's down 0.1% from August, but the core, again, excluding food and energy, is up to 2.8% this month from 2.6% last month. The Fed likes to look at the PPI because it tends to give a little bit better immediate outlook for what's happening in the economy. If producers are charging higher prices for finished goods, that's going to ripple into consumer spending or the consumer price index a little later. So the Fed gets a little bit quicker read on the producer price index. But both of these are showing that inflation could be remaining a bit sticky here, which is not what the Fed wants. Time will tell. Let's look at what's going on with yields on the 10-year Treasury. After skidding for the last 2 months sharply, the 10-year Treasury yield in red on this chart has rebounded sharply, especially since we got that strong jobs report, which means the U.S. economy may not quite be as weak as had anticipated. So we've seen a sell-off in bonds, which has pushed the Treasury yield higher. Meanwhile, you can finally see on this Fed funds rate in black, the Fed's jumbo rate cut is showing up on the chart. So we've seen a bump up in the 10-year Treasury yield from a low of 3.65 to 4.09. It was pretty sharp, and over the last couple trading sessions, it's just continued to edge a little bit higher on a daily basis. I think that this is getting close to topping out here. Time will tell. Let's look at what's happened with the dollar, and the pattern is similar for the dollar for the same reasons. We've seen the dollar skid sharply on the U.S. dollar index from early August at 102.7 all the way down to under major support at 100.65, where it bounced a little bit, and now a sharp rebound in the dollar over the last 2 weeks, despite the Fed's jumbo rate cut. And that again goes back to the U.S. economy looking a little bit better from an employment situation. So the dollar has been pretty strong, and this is a pretty sharp rebound. We'll have to see how that continues to go. But like the 10-year Treasury yield, it's been really sharp at first, big gains, and now small gains over the last couple of trading sessions, which indicates that the momentum may be starting to fade in both the rising 10-year Treasury yield and the rising dollar against other currencies. Meanwhile, we're waiting for the other shoe to drop between Israel and Iran following Iran's ICBM attack on Israel a week ago. The concern that I have is that this conflagration is just going to continue to expand as Prime Minister Benjamin Netanyahu in Israel continues to prosecute the war against Israel's adversaries. After cleaning up pretty much the Gaza Strip and Hamas, they've turned their attention, of course, to Hezbollah and Lebanon, and they've been relentless in consistently taking out the opposition through that sensational pager strike and walkie-talkie strike and these decapitation strikes on the leadership and command and control through taking out Nasrallah and his replacement. And now Israel's mulling over how to respond to their attack from Iran. And this is what concerns me. Israeli Defense Minister Yoav Gallant said on Wednesday of this week, our attack on Iran will be deadly, precise, and above all, surprising. They will not understand what happened and how it happened. They will see the results. So clearly, Israel is waiting to produce a big retaliation move against Iran. And when that happens, it could change markets very quickly, all markets, very fast. And my concern is that this is just going to continue to become a greater and greater conflict. And as you can see on this headline from the Jerusalem Post, Moscow expands ties with Tehran as Israel weighs a retaliatory strike on Iran. So it's increasingly becoming a bigger conflagration, and we're waiting to see how the U.S. responds to whatever Israel may do. So this is not good, and it could easily become much worse very quickly, which is very concerning. Let's get on to the metals charts. This is a one-year gold chart. We've shown you this before, of course, and you can see that big run from beginning of August all the way to the 2708 top in late September, and now that modest profit-taking correction dip that we've gone through. On this chart, I've got support at 25.85, that little green line, but we've held above that on a daily close basis in the futures market. So gold was taking a bit of a profit-taking breather, and now we've seen it punch back up in just the last two trading sessions. And it's been a pretty sharp rebound. So we're back into the middle of the 2,600 to 2,700 trading range that we've established. And this is the first real pause we've seen in gold since that first week in August. Here's something a bit interesting I'd like to show you. This is the same one-year gold chart with that run up and then down just in the last week or so, highlighted in yellow, because it shows pretty well the inverse correlation of gold to the dollar. This is the one-year dollar index chart again, showing in highlighted in yellow that same inverse down move for the dollar and then up, which of course is the opposite for gold. In my Gold's Bullish Perfect Storm video, I showed you a more dramatic inverse dollar to gold correlation during 2022, which was severe. I'll link to that video if you want to take a look at that inverse correlation at that time. A link will be in the section below for comments. Moving on to the 6-month daily candlestick chart, you can see how despite the correction that we've gone through, gold has held support right at 26.15 in the futures market on a candlestick basis. Now, this blue line of support, I've had this in place for the past month or so. And I told you in our last video that gold had gotten over trend. Well, this correction has put it back down to trend where it tested support. And now those two candlesticks off to the right that are not red, that are hollow in the middle, that's the last two trading sessions and the uptick that we've just gotten on this past Thursday and Friday. So far, gold is holding its trend line very well. And this bodes well for future gold movements. Time will tell, of course, but right now you can see that trading range that we're getting into in the futures market between 26.15 and 2,700. A move above or below either of these levels will signal weakness or strength as we move forward. This is a one-year silver chart, and you can see the big V-shaped dip that we've seen, and now silver which has corrected lower way off to the right just in the last week, has had a big move up again just in the last two trading sessions. So silver is actually a bigger gainer than gold at this point in time at 38%, 12-month basis. And let's take a look at this one-year silver chart a little differently. This shows that we've got an inverse head and shoulders formation developing, with the right shoulder now starting to become a bit clearer over the last 6 months, and especially over the last couple of trading sessions. The right shoulder has firmed up with the neckline at 32.45 basically. So silver is showing the same inverse head and shoulders pattern that it showed previously over a multi-year period before it broke over 29 this April. And I detailed that in our Is Silver Ready to Run video. So silver's still trying. Looks like it's going to retest this breakout, and anything over $33 is a clear breakout for silver. And it's holding support right where it's supposed to at 30.50 right now. So let's look at that on the candlestick basis. You can see right at 30.50, silver has bounced off. This is a pretty busy chart because silver is more volatile than gold on a daily basis. And I've highlighted in here the China stimulus announcement, which is that move up about 2 weeks ago, which we thought might lead to silver breaking out at that point in time, which is why we put out Is Silver Ready to Run. But now we've seen a correction, primarily because so far China has failed to deliver on the promise of that stimulus. And the day that silver took that big $1.50 drop from 32 down to 30.50, that's the day the market kind of realized, oh, so far what China has announced for stimulus is a bit of a dud. But there will be a new announcement this weekend, Saturday. You'll see this video on Monday. So we'll see what happens. So silver looks like it's going to try and break out again. It may be a little while before it does that, but between the head and shoulders pattern and the way it's rebounded off of major support, and it's not that far from upside resistance at this point in time, silver's looking very good. So here is the gold to silver ratio chart that we like to show you. It's back up to 84-1, which remains high. So silver continues to remain undervalued relative to gold. So if you're interested in precious metals, I think you should have your focus on silver for the short term. If you don't have anything, we'd recommend a mix of both gold and silver, because gold will continue to lead overall. But when silver plays catch up, it tends to do so with a vengeance. And over 33 would lead to 35 or 36 pretty quickly, and perhaps a test of 40 as well. And I continue to believe that at this price of gold in the 26.50 to 26.60 range, silver ought to be $40 an ounce already. And speaking of silver, we have a couple of great specials still in place. We have the 1 ounce Asahi refinery made 1 ounce buffalo rounds. These are a major refinery made 1 ounce buffalo round. They're as low as $1.99 over spot. That's a great value. We continue to have, but we're getting low on 2023 1 ounce silver Britannias, as low as $2.79 over spot. And for US Silver Eagles, we've got them on special as low as $4.49 over spot. So these are three great values to be had in physical silver if you want to add to your physical silver positions. So that's my update. And once again, and as always, thank you to you, our loyal clients, for the trust and support that you've placed in us over the last 26 years. Without you, we simply don't have a business. So there's never a day that goes by that we don't thank you for the loyalty and the trust that you've placed in us. We'd like to help you if we can in these markets. If you like what we're doing, please subscribe to our YouTube channel and like this video. If you have any comments, I'd be happy to hear what you have to think or have to say about the work that we're doing. So thank you so much for your time this week. Thoughts and prayers go out to everyone in Florida affected by the Hurricane Milton. And we're very concerned about what may happen in the Middle East going forward. So let's pray for a good outcome there as well. So thank you very much. Have a good week.